So if you're only here to buy the sexiest stocks and you think that's the right way to do it, let's take a look at them very quickly from a 500-foot perspective. It's possible to overpay for a good thing and underpay for a bad thing. All right, guys, 3 stocks, 52-week lows: Kohls, Levis, and TopGolf Callaway. Callaway, the golf company, owns TopGolf, and this is their merged. It used to be ELY was their ticker, now it's MODG. Let's take a look at them very quickly from a 500-foot perspective. Now, if you're new to the channel, my goal, I look at every investment as the present value of all future cash flow. Right? That's very, very important to me. And I also believe it's possible to overpay for a good thing and underpay for a bad thing. Value is what you get, price is what you pay, right? So if you're only here to buy the sexiest stocks and you think that's the right way to do it, listen to my perspective. If it doesn't make sense to you, I'm okay with that. Go about doing your business. I will do my business. You have to invest the way that makes sense to you. But if you've been watching these stocks go massively up and down, you look at a company like Nvidia was low $100 just a few months ago. Now it's $300 and some a share. If that confuses you, this might be a way to understand that, okay? In the short run, stocks are a voting machine. In the long run, they're a weighing machine. That means in the short run, the most popular ones are going to go up and the least popular ones are going to go down. But in the long run, the fundamentals are what's going to drive the stock price. If you pay a reasonable price today for any investment and you're able to drive up revenue and profit and keep shares the same or going down, that stock price is likely to go up. That's the key here. So let's look at Kohls. Kohls is in retail. Tough business. At 2020 low, it was at, what was that roughly? Oh boy, why can't I? There you go. $11 a share. It got as high as 65, 62, and now it's back to 19. We've seen this in a lot of retail businesses. Big Lots, this one, Foot Locker, they surged and then fell back down. Now, I will say this interesting thing. Their cash flow last year was $750 million. Their 5-year average free cash flow is $960. This dividend yield, I want to verify they're actually going to keep this thing. That's incredible. Now, bad return on invested capital, but I don't know if that's the play here. I don't think this is I care a lot about this if it's a company that I want to have a long runway on. I want to watch it for a long period of time and own it for a long period of time. I don't think Kohls is that play. If you're going to buy Kohls, I think it's a short-term play based on a mispricing of value. All right? Because I look at a lot of cash flow here, and their market cap's only $2 billion, and yet their 5-year average free cash flow is almost $1 billion, and their 1 year is $750. So let's open up that free cash flow real quick. Let's look at that free cash flow number. I mean, they've had positive free cash flow every year for the last, has it been every year in the last 20? 2 years of negative free cash flow in the last 20 years. That's pretty impressive. Now, let's go look at revenues. Okay, it started out at 19 billion, went to 19, 18 and a half, 19, 17, 16, 18. Oh, but we got to go the line below. It's at 20.4 last year. All right, so slightly growing. I mean, this isn't a sexy company. It's the same level it was in 2018. This is not guys, retail's changed. Retail is changing more and more. And as Amazon does more and more to drive retail sales, people are going to do more online. Like this weekend, we were at my house, my fiance and I, and we needed new dog food. We went to a website, literally ordered the dog food from a local store. It was delivered to our door within 45 minutes. Free delivery, because it was $100 worth of dog food. Literally, my fiance goes, the door was open and she goes, "Oh my God, it's already here." I go, wonderful. It was faster than Amazon. And that's how these companies have to compete. Now, I know a retail company that owns a lot of retail locations, and you know that they were telling me when Kohls first started to do this, they made Kohls like an Amazon return location. That way, people would get into stores and start buying more stuff. All right, let's check out the profit on Kohls. All right, so last year, a negative 300 million. That's random because they've had profit every year for the last 10. So what I do when I see that is I scroll up to see if there's any one-time write-offs. A $300 million write-off here, it's not too, I mean, they have other income expenses are pretty consistently 100 million plus. Interesting. Gross profit was down a lot. Look at that. So last year they did 19.3 billion with 8 billion in gross profit. Higher revenue this year, but lower gross profit. So they had a higher cost of goods sold relative to revenue, right? That's almost a $3 billion swing right there. Okay, that's a big number. Understand why that is. Were they unloading a lot of inventory at lower margins? That's probably the reason. I don't know this for a fact, but that's what I'm looking at. All right, so let's look at the 8 pillars real quick before we go to Levi's. All right, shares outstanding down a ton. They're buying back a lot of shares. Remember, guys, if you have our software, you can do your own custom 8 pillars, up to 12 pillars of your own. There's like 4 quadrillion different variations. But net income's down, low ROIC. I don't worry about that for a short-term play. Buying back a lot of shares. Cash flow's down, long-term debt. I mean, guys got to value this thing. Have a conversation in our community. So guys, this is our software. This, along with all of our other tools, are available. We're running a special $7, 7 days. That's $1 per day to try our software. This is a no-brainer. You get the community, you get all these tools. You get our stock analyzer tool. And our stock analyzer tool is what really has changed our software. It was used 1.3 million times last year. It allows you to make your assumptions on a company between 1 and 20 years, and it'll tell you what price to pay purely based on net income and free cash flow on what price to pay for the company, if it's overvalued or undervalued today, just based on the income statement and cash flow statement. It's a great way to do it. Let's check out Levi's. So Levi's is a big brand, obviously. Are they a big, awesome brand? I don't know. Is this true? They've only been public since April of 2019. Interesting. High return on invested capital, 11.6%. Let's check out the income statement. No, that's not true. Or maybe just it provided it. So the revenue is growing. We're going to go back to 2016. Very slow growth. Profit is there. The only one year they didn't have it was coming off of COVID, that full year after COVID. Okay, let's see shares outstanding. Slightly down recently, but up from the past. All right, let's see the cash flow statement. Let's see how their cash flow is doing. Remember, guys, cash flow is the metric I look at the most. So if you're new to the channel, I look at cash flow so much because I want to understand the money in, the money out. At the end of the day, net income can be altered with so many different rules, so many different manipulations. Cash flow is harder. So I want to sit here and understand this cash flow. And it dropped big time here. And I look right up here, changes in working capital was the culprit, okay? So that might be a temporary thing because look in past years, changes in working capital swung from negative to positive, and really the swings weren't huge. That's a big, big difference. But the average free cash flow is $200 million over the last 5 years, and the company's market cap is $5 billion. That's 25 to 1. So let's go to the 8 pillars and see. 4 X's and 4 checks. Low PE, high price of free cash flow. That bothers me. Free cash flow is down. Net income's up slightly. All right, let's do a little stock analyzer tool on this one. Let's see how Levi's, if they're able to keep a brand for 20 years. Let's see how it looks. Let's go to a 20-year analysis here on Levi's. Now, they're clothing. So as long as they keep their market share or they keep their growth just growing in number of units, their revenue will go up because of inflation. Because you're telling me, I mean, 50 years ago, how much did a Levi jeans cost to make versus today? It's going to be a lot higher today than it was 50 years ago. That'll naturally just drive up. As people make more and more money, they're going to pay more and more for clothes. So I'm going to sit there and assume no growth on the low side. I want to be conservative. 3% in the middle, 6% in the high. So they're able to rebrand, get some more actual unit growth plus some revenue growth because of their prices going up. Profit margin, I'm going to go with 5, 7, and 9. Free cash flow, I'm going to go with 4, 6, and 8. Now PE. Now, PE is a hard one here because on a no-growth company, but it's got a pretty decent brand name in the sense. I don't know if many people like to buy Levi. I don't know if they do or not. I'm not really a clothing person in that regard. I just see a pair of clothes that I like, and I'm like, I'll get that. So I'm more of a watch person. So I'm going to go 12, 14, and 16. And same with the price of free cash flow. Now, finally, for my desired annual return, guys, this is essentially going to have your margin of safety. You can invest in a long-term ETF and get 9 or 10%. So if you want to make a value play and a way to get some real good on your money, good return on your money, the higher your desired return, the more your margin of safety. The higher return, the lower the price you have to pay. Think about that. If this phone's worth $1,000, you're gonna get a higher return if you pay $100 for it versus $900. So the higher your return requirement, the lower the price, therefore the higher margin of safety. So you wanna see a higher number usually as we go higher here. Okay, because these are less likely to happen. So I'm gonna go, since it's a play that I don't really wanna own long-term, I'm gonna do 12.5, 15, and 17.5% return. I'm gonna hit the analyze button. The stock's currently at $13. All right, low side, 5.5 to 6.5, high side, 12 to 14, middle, 8 to 10. So it's not an obvious screaming deal to me, so I'm just passing from here. And this is what I recommend you do. Look at the stock. If it doesn't immediately spark your attention, move on. Don't spend any more time on it. That's what I like to do because I want to go look for more stocks that make more sense. Now, last one, MODG. MODG. TopGolf Callaway brands. Now, this used to be ELY, like I said. And its 52-week low was just hit today, $16.18. Boy, going back to 1994, it's only up 300% in almost 30 years. That's not very good. And they're not showing a dividend here, but look at this, guys. This is what I don't like. Last year's free cash flow, negative 500 million, 5-year average of 98, not 100 million, negative 100 million. Now, I will say this. One thing I want to look at is how much of these capital expenditures have been Topgolf locations. Because look at their capital expenditures here. Very, very low. From 10 to 50. All of a sudden, 400 million, 500 million. So go understand that Topgolf. What are they trying to do with that? What does it generate? How much money does it generate every year? Those things are incredible. We're going there this Thursday, is it? We're going there this Thursday. I was there 2 weeks ago in Dallas at the Topgolf, one of the Topgolfs in Dallas. Fun experience. I love the food. They have Coke Zero, so I'm a big fan. But again, you need to understand that business they're trying to get into because that potentially is the reason why they have so many capital expenditures. When they open a new Topgolf location, that's a capital expenditure. That's very important to understand. So if they're going to spend, hypothetically, $50 million on a Topgolf, you want to sit there and say, hey, are they driving $6 to $10 million a year in extra net income from that and cash flow? That's the question. That is the question. Let's look at their return on invested capital. It looks pretty bad here, but usually on growing companies, it can be affected. The return on invested capital can be affected as they grow the company. So it's a little misleading, but again, it's a cause of concern for me. $3 billion market cap. Let's go look at their 8 pillars. Oof. Guys, all these X's, high PE, not enough data on the free cash flow because it's negative. My comment is go understand Topgolf. Go understand their Callaway brand. Go see how it's driving things. If you can see a real high return on invested capital in those locations, calculate how many they're going to do, how many they can possibly make, and see if it makes sense long term. So guys, 3 stocks, 52-week lows. If you like the software, $7 for 7 days. Check out everythingmoney.com. $7 for 7 days, $1 per day. Check it out. Thank you very much.